Hello and good evening, everybody. Welcome to Investors Coffee Time tonight. And today's session is basically on focus on Singapore market. So we call it Singapore Tuesday. So for the next 15 webinars, we're going to focus on Singapore and what it has to offer. Right, Jake, how are you? Oh, I can't hear you. Is your mic mute? No. Hold on. Maybe it's me. Let me check. Okay, looks I'm fine. Can you say something, Jake? So, okay, hold on. Hello. Now, can you try removing your headset? I think it's not working.
What about now?
Yep, now I can hear you.
Oh, okay.
Yeah, it's probably the headset setting. Okay, right. Can hear you well right now. And welcome to the show. I'll make a short introduction later. Who Jake is, and basically Jake is the market strategist in CGS-CIMB research, and he's based in Singapore. Right. So since today is the first part of the whole Singapore series, we want him to give us an outlook or look at the opportunities that Singapore has to offer as Malaysian investors. Right. So I know we have worked with him. We have worked with also a few of other speakers to basically just focus what really Singapore has to offer that maybe Malaysia do not have. All right, so that's what the focus is going to be for the next 15 webinars, and hopefully we'll continue to join us. And if you think that anyone who is interested in the Singapore market, please do tag them. Invite them to this live stream, and also please do share this live stream in your Facebook so that they too can view today's live session. And you can ask questions to Jake later on as well. So you have any questions while he's presenting today, you can put the questions in, and then later when we have probably half an hour to answer your questions. All right, so what's going to happen is Jake is going to do his presentation first, and then we're going to have a Q&A session with him. All right. Okay, so guys, before we start, if you can hear us very well and see us, can you just say yes in the comment section so that we can begin? Right, thank you for joining us, everyone, tonight. For those who have joined us, just join us. Thank you so much for joining us this evening. Hi, Casey Lee. I see Wendy Wong is in the house. KP Chin is in the house. Himin Pang, Tan Buk Su, Chia Chuan Sun, Jason, Jatinda, Harry Quay, Daniel Tu. Oh, all the die-hard investors are all in the room tonight. Okay, so I guess you probably want to know what Singapore has to offer, and you know what, I also do not really invest in Singapore, so I really also want to know what Jack has to say. And what are opportunities available in Singapore. All right. So thank you guys. Thank you for your thank you for your comment. So we are ready to go. Hi, Billy William. So before we start, as usual, today's conversation, today's sharing, whether it's from Jake or from myself, is for educational purposes only. It's not intended as any investment advice, right? So if you want to look for any investment advice, please do look for a professional and licensed investment advisor. All right. So let me introduce Jake a little bit. Basically, Jake Chow, he is a chartered market technician. All right. A chartered market technician is one of the a certified technical or price chart analysis certification, which is not really easy to get. I think I only know about one or two guys here in Malaysia. I'm not sure how many there is in Singapore, but generally this is quite. There are not many of them who hold this certification. All right. So Jake Damien Chow has a certification, right? A CMT certification. So he's a market strategist with CGS-CIMB research, and he's responsible for basically overseeing the development of technical and quantitative research from within the firm. All right. So he has been also speaking in conferences, and he was awarded as one of the third best investment speaker during the investment fair in 2019. So basically, he's currently in charge in doing research, development, and manage in-house quantitative trading and investment strategies. All right. So other than that, he's you can download the slides later on, and I share with you how you can download the slides. And you can see his bio in the slides as well. All right. So what I'm going to do is I'm going to pass this to Jake. And guys, if you have any questions, and Jake, you can start sharing your presentation slides right now so that we can break it up. Yeah. And if you have any questions, please do type in the questions during his presentation, especially so that he can answer them later. All right, because we do not want to disrupt him during his presentation. We only answer those questions after the presentation. Okay. All right. So Jake, is you can okay, I see your slides there. Yep.
Oh, you do. Okay, great. Thanks. Hi, everyone out there. My name is Jake. I'm a CMT charter holder. I'm currently a strategist, like what Benny mentioned, and intro. I am a very strong advocate of doing everything systematically, whether it's trading or investing. So I would say I'm in love with what I do because it's simply very creative process that I get to do a lot of strategy creation, a lot of back testing, a lot of implementation of the ideas. So bringing ideas into live models, whether it's a trading or investing model, it's very fruitful. And of course, I keep telling people, I said, look, I don't understand why there are a lot of market commentators or there are a lot of investors out there who says the market is uncertain. Naturally, if we understand the true nature of science, physics, that inherently, or rather this inherently, our very existence is by nature a law, abides the law of probability. Nothing is certain, especially at the quantum level. So that translates into a lot of things that we do in life, our day-to-day activities. Every decision we make in life has got some, or rather obeys the laws of probability. So we have to make the best decision for ourselves. And of course, my investment and trading philosophy is built around capturing beta and harvesting beta and capturing alpha. So that means we try to do the easy thing first. To capture the beta means you try to get market similar or return similar to the markets. And of course, if you are able to do a lot of tactical allocation or sector rotation, that's when you actually extract or capture the alpha within the market. And of course, it's not easy. If you ask me, I would simply say investing, it's like riding a bicycle, whereas trading, especially short term, is like driving an F1 car. So whether we are trading or investing, I always emphasize that we use a call and satellite approach to invest, especially for longer term investors. Actually, for trading, you can do the same thing. So nothing is set in stone that you should do this and not that. And strategy is very flexible. In anything that needs to be won, it's won with a strategy. That means you plan how to achieve your objective, how to get there, and execute the plans. And of course, before I start, I would like to quote Peter Lynch, the legendary investor. You get recessions, you have market declines. But if you don't understand that's going to happen and then you're not ready and you won't do well in the markets. And of course, all of us, at some point when we're in the markets, we tend to feel nervous. And if you have a plan, I guarantee you won't feel that nervous because you have everything planned out. Whether right or wrong, you know how to move in and out. And of course, moving on to the disclaimer, I think Benny has already done a very good job trying to say that whatever that's presented tonight is meant for sharing. Any professional investment advice, please do seek out your personal investment counselor or your stockbroker. So let me just summarize what I'm going to talk about tonight. Okay, first I will begin with what drives returns, and of course our market structure in Singapore, and of course what drives the Singapore market, and screening for ideas on how to deep dive into cementing some of the ideas to be included in your investment portfolio. And of course, we'll finish off with key takeaways. Right. So, what drives returns? Not just in Singapore, in terms of all investment classes, or rather all asset classes, whether we're talking about fixed income, equities, commodities, and even FX for that matter. Right. So sentiment actually sets the market going. Like it or not, it is day to day affected by our sentiment, mainly our confidence, optimism, and expectations in the marketplace. That means collectively, investors, traders are expressing our views, our fear, our greed every day in the market. And generally, people call this sentiment. And of course, sentiment, for anyone who knows Singapore market, you know, you need to pay your COE to drive a car in Singapore or to buy a car in Singapore. So I typically coin this sentiment as COE, confidence, optimism, and expectations. So these three sub-factors influence or form the core of sentiment that we see day to day in the marketplace. And of course, our professors taught us things like efficient market hypothesis, CAPM, and the markets are totally random and efficient. Well, if that is true, then no traders or investors in the world will ever make money beyond the market returns, what we typically call the beta, right? So if let's say, let's say statistically, global equity returns return you about 7% annualized on a long-term basis. So that means if let's say you're an investor or trader who's consistently can return, say, 10% over a period of 5 to 10 years, that means you are beating the market. And of course, in order for that to happen, you really need to have something extra. You need to have an edge in the market, or at least some sort of some part of your strategy. It's very, very efficient to constantly and consistently beat the market. And of course, what drives the market to price what it is now and tomorrow and sometime down the road is typically what we call the risk premium. Typically the risk premium is what premium that we place on all the asset class that we invest in. In this case, for example, the statistical returns on government bonds is typically 3 to 4% over the long term, and equities about 7 to 8%, around that range. And therefore, you have a risk premium. And when those risk premium widen or broaden, it tends to affect how people invest or make decisions and how global investors allocate money. And one thing to note, or one thing to mention would be, like, for example, the current low interest rate environment is actually driving a lot of global investors to deploy money or to put money to work. So therefore, we are constantly every day pricing the risk premium in the marketplace. And our statistical research, I would say, is not just us, but globally, the average time that the market spent trending is typically between the range of 60 to 65%. That means on a daily basis, or rather, if let's say you're flipping a coin, right? So when you flip a coin, it's 50-50. But the market tends to trend around, or tends to be up 60% to 65% of the time throughout its lifetime. So if you ask me, betting or investing your money in the markets is much more safer than walking into a casino. But it's a matter of how do you apply your strategy and how do you react and behave in your investment life cycle. So of course, when the market when the markets go into correction or what we call a mean reversion, those are the negative months or negative periods that the market will go through. Those periods are meant for the markets to correct itself and to get rid of the excess in terms of the valuations. More often than not, we build, or human beings build, a bubble in the marketplace, and when you reach a level where the valuations are obscenely unacceptable, it will correct itself, and that usually will depend on a particular instance, or sorry, a particular trigger. Like the recent COVID is a good trigger for the market to correct itself. Will we move into a bubble? I would say yes. We are constantly creating bubbles within the marketplace. Like it or not, there are bubbles here and there. In fact, some of the data that I'm looking at is suggesting that we are actually in the midst of creating another tech bubble. But of course, I wouldn't be able to tell you when exactly it will burst. But instead of fearing that, we should embrace it, because these are the time that the market correct to a meaningful level whereby uh, it has more risk reward, or the risk reward ratio for us picking up the bargains, or stocks that are trading at more reasonable valuations. I would call that the Great Singapore Sale, right? So that is a period for us to step in and get some bargains, especially from an investment viewpoint. So of course, ultimately, most markets, with the exception of some anomaly, tend to resume their long-term trend upwards. So what the market is trying to do is what we learn in school, when we learn in school when we draw the equilibrium chart, right? So more often than not, we have to find or match the equilibrium point for demand and supply. I hope you still remember how to draw that. Yeah, yeah,
This is basic
correct.
economics, right?
It really ties back to economics. Just that it happens over a long period of time. We tend to forget, right? So yeah, the technicals actually help you to find or rather some sort of indication that what the market is doing and thinking right now, and even to a certain extent, the risk reward ratio for us stepping into the market at this point, or is it better to wait for us to step in at some point later on? Yeah, so yeah, that's the thing. So market trend around 60% of the time, and it reverts back to its meaningful valuation levels, but that will take time. And of course, it resumed back to its trend, because ultimately the broad market creates value over time, right? More often than not, the global indices incorporate names that are a mixture of blue chips and growth stocks that will enhance our life over time. Yeah. So of course, back to the risk factors that what we like to um, in quant speed, sorry, in quant language. Um, a lot of times people often associate momentum with technical analysis. I would say yes and no. In fact, the fundamental school, um, or even fundamental school, and also the academics have accepted that momentum is a valid risk factor, right? A lot of literature, a lot of professors have openly embraced that. In fact, I can safely show statistics to you, evidence to you, that without momentum, right, those guys who beat the market will not achieve what they said they are achieving, because even though you're a value guy, more often than not, you could be riding the coattail of momentum without actually knowing it, because momentum is actually um, a fashionable expression of that time. Like for example, right now, the marketplace is um, let's say very bullish on momentum. Sorry, bullish on tech sector, the healthcare sector, the consumer discretionary sector. So well, the investors globally are expressing that same view, and collectively that creates momentum. And of course, back to value. Value, as what we know, has never changed. So all these risk factors are nothing new. It's just a way of the guys looking at the market in a more scientific way, that we can drill down into portfolio level, what's actually contributing to our portfolio returns, right? So in this case, value is very important in all investment analysis, how your portfolio actually perform over time. And of course, size is actually one of the original factor in the two-factor model proposed by Eugene Farmer. And of course, from two-factor it went to 3, 4, 5, and in fact, the father of the father of our modern CAPM and modern portfolio theory actually reject momentum. Yeah, he openly rejects momentum, but in the fund that he advised and helped to manage, dimensional fund management, it's a pioneer and well-known institutional fund management that is managing hundreds of billions of dollars. They actually use momentum. Yeah, they openly say no, we reject momentum, but they do practice momentum in their portfolio management. Just that everyone is keeping quiet about it. Yeah. So momentum is very crucial to improving your performance, and in fact, to a certain point, it can actually help to mitigate a lot of risk. And of course, moving on, you have things like your quality factor. Quality factor is one of the key things in the investment field that a lot of people couldn't agree on what's the commonly accepted criteria for quality. But essentially, to make things very simple, stocks with very good balance sheet and profitable companies, right? To make it easy to understand. And of course, lower risk stocks typically have lower volatility. Those are your typical blue chips. And of course, this factor that we call dividend yield or yield factor, it's basically what is being paid out from the company's cash flows. So some people actually incorporate dividend yield into their valuation factor when they're doing modeling. So sometimes even I mix in the dividend yield into my models to make it as the way I want it, because not all strategies are the same. So different strategies have different models behind it. So as you can see over here, typically when the market is feeling rather bullish, broadly speaking, or the pro-cyclical factors that you will see or experience in a general tide, it's the value factor typically outperform when the market is feeling bullish, because that means the broader market is willing to take on more risks. Because typically the value factor means you have to take on more risks. The reason why some of these stocks are value or cheap is because it's actually trending down, right? A lot of the stocks within the value factor are typically your more blue chip stocks, your financials, your banks, your industries, your old names that are perhaps going through a rough period, and therefore they are cheap, right? So when the tide is moving up, very likely people are more willing to take risks and they will look for cheap stocks to buy. So as a whole, right, when the market is feeling generally bullish, these are the factors that typically outperform the rest. But that doesn't mean the rest of the factors like quality, low vol, and dividend yield don't perform or they are negative, just that they tend to underperform. That means the marketplace is not paying too much attention. And right before the COVID, we actually witnessed a switch or rotation into defensive factors like dividend yield and quality and low vol. When you track the market on a regular basis, you will see that the US rotation happening right before the COVID happened, right? So we can actually track the market, and we can see what the global fund managers are actually doing. So that could actually help a lot of active investors who may want to practice active investing or sector rotation to keep a closer track on what the US is doing. And so that's my advice. And of course, so back to our Singapore market structure. Every market is uniquely different, but of course, Singapore market is generally a little bit smaller than the Malaysian market. If you look at the number, just by the number of listed counters right now, we have 703 listed names in our market. And of course, we have 85 names that are above $1 billion in market cap. And we have about 121 names that are above $500 million in market cap. So every market is different because people tend to say, okay, what's the size, right? In the Singapore context, we we typically think that 1 billion is a big or mid cap level. We tend to treat companies more than a B or less than B to be small cap in the States or in US rather. So anything in excess of, I would say, 4 to 5 billion is not considered even mid cap in US. Yeah. So of course the size difference matters. And of course, we have roughly about 169 names right now that are worth 250 million. And that creates some problem because a lot of fund managers cannot invest anything less than 500 million to 250 million, around that range. Anything below that is deemed as micro caps. So therefore, um, actually, some of the investors who are very well, they're savvy, they have done a lot of homework or research, they can actually look into the smaller caps, but they really need to practice discipline to extract alpha from it because these names typically are less liquid and more prone to manipulation, right? And of course, currently we have 42 REITs, used to be 44, but two of them has merged. So we are known to be the regional center for REITs apart from Australia and Japan, right? So regional investors, in fact, global investors tend to look at Singapore market for any REITs exposure in the APAC. And we also have 15 business trusts listed on the SJX. And we have currently 57 index ETFs or exchange traded funds currently listed. We used to have around 70 odd. But as time goes by, we consolidated some of the ETFs and some of them actually choose to be delisted. And of course, three of the ETFs listed are actually REITs ETF. So instead of, let's say, getting yourself exposed to REITs, you can actually choose to buy into one of the REITs ETF to get that same exposure, whether you want a pure Singapore exposure or the regional exposure. We currently have three ETFs, one of which is a pure Singapore exposure. That is the Lion Philippe S REIT ETF. It currently has about 233 million in AUM, and the expense ratio is roughly around 0.6%. And the indicative dividend yield is 4.7. And of course, the other two REITs, ETF REITs, are regionally exposed. So depending on what kind of exposure you want, right? And of course, we have other stuff like structured warrants, not too different from the Malaysian market, I suppose. And we have this new instrument called the DLCs. It's daily leverage certificates. And we have things like ADRs, and we recently launched single stock futures. So, but that's not the topic for today. I'll move on from here.
Jake, can I pause you for a while?
Yeah, sure.
Yeah, there's a question actually. There's a question from one of the audience asking, what's a business trust?
Business trust is typically anything that anything that they don't classify as a property trust. That means it could be a logistic trust or what do you call it? Logistic industrial trust, or anything that's in between a hybrid. Yeah, that doesn't fall under the strict categorization of residential or commercial property trust. It could be involved in things like your utility, for example. Yeah, we have.
Right. Any business outside of properties,
Yes, correct. Yeah, correct. So
Mm.
classification is something that we have to contend with. Yeah,
Right. Okay.
yeah, correct. So okay, so what drives the Singapore market? Um, every country is unique in that sense that in this chart that I'm presenting to you, um, we are looking at currently we are looking at the quarterly chart. That is, it's a long-term chart dating all the way back to year 2000. Because I like to look at as much data as possible. In fact, if you ask me, I would generally look all the way from the beginning. That means when I'm looking at the US markets, I tend to go back to 1927. Yeah, to really study the market and see what's going on since time. And of course, the rest of the world, we tend to have less data. That's why a lot of research, whether it's professional research or academic research, we tend to look at the US markets, right? But in this case, our market is a bit regional, so things are a little bit different. For example, the line in red is our ST China index. The dotted line that you see in white across the last 20 years is actually our STI All Share Index. That means it incorporates most of the market cap, most of the names that are 98% within the market cap space. That means we're looking at most of the big and mid caps names, big and mid caps names that you can safely invest in. That's roughly about 120 over names. Yeah. So that would, I typically use that as a benchmark, not the STI index, right? Because the STI index only has 30 names. And the line in green is actually the STI index. It typically includes big caps and big and mid caps that are well established, typically recognized as blue chips. But because of the index formation or index weightage, we tend to lean more towards the banks, right? So the banks itself has about 40% weightage in the index. So when I typically look at index, whether it moves up and down, I know the banks, usually the banks are the ones driving it, right? So it is a proxy for the performance of the banks. So just a simple look at this, you can easily conclude that the banks typically outperform the broader market in this case. And of course, the blue line is actually the shipping, the maritime index is actually the shipping index, but it's not quite meaningful because this index has only two names, right? And you can see it's rather inconsistent because the pre-subprime it actually outperformed. It went crazy, it went parabolic. Yeah. And after subprime, you see that the outperformance actually disappears. So it's not consistent, right? So I'll typically ignore something like that. And this line, what color do you call this? Aquamarine, I think. Yeah, it's actually the consumer goods and services index. So it has names like for example, Wilmar, our commodities trader, or names like um, what else? SIA, yeah, SI is part of the index. Yeah. So if you look at this, you can more or less conclude that over time it tends to lag in terms of performance uh, against the index, against the broader market. Of course, it really depends on how the market is being constituted as well. But that's just generally how anyone would analyze the market, which sector typically outperform with a consistency, right? Of course, the key thing would be this gray line that you see over here across time, across the three recessions that we went through. It consistently outperformed the broader market, and that includes the banks as well. I I believe real estate is a big part of most of the regional Asian investors, and therefore that it's a big reason why that the property market or the property sector is driving most of the gains within our broader market. And um, this gray line is it's one of the property exposure that you see. It's actually the REITs, and this purple line is actually the property developer or the construction sector. So both, I decided to include both lines because I want to separate the REITs from the developers. But as a whole, you can see these two or these two subsectors actually outperform the broader market. So in a nutshell, the property sector is what is it's one of the chief driver of outperforming gains in the Singapore market. Sorry, I think I'm talking a bit too fast. Oops. Okay. Yeah. So once we recognize that, we should pay more attention to the property names within Singapore market, and of course, I'm looking at the size factor in this case, right? This chart is also a long-term chart, going all the way back to 20 years, starting from the dot-com bubble. And you can see the white dotted line is actually our broad market index, the all ST all share index, right? So we will focus on this purple line that you see over here. This purple line is basically the mid cap index. So you're able to see that the outperformance is rather consistent. That means the mid caps tend to deliver outperformance against those big caps in question. That big caps, that means things that names that are like, for example, your banks, your your what else? Your ST Engineering, your Singtel, yeah, correct. So typically, it's not difficult to understand this. That means the earlier um, risk factors that I mentioned, the size factor, actually does work in the Singapore context. However, a word of caution. The small cap and the capitalist index, in this case, tend to underperform the broader market most of the time. You can see this yellow line over here. That's the small cap index. Benny, are you able to see my cursor?
Yeah, can you point once again? Let me try and
Oh,
see
sorry.
if you
I should go back. Yeah, this yellow line that you see below the white line, yeah, it consistently underperformed the broader market. That means the smaller cap names um, are very likely to be manipulated, pump and dump kind of stocks. So investors, please be careful about small caps. And of course, last but not least, our capitalist index is this red line over here. It also spent most of the time underneath or underperforming the broader market. So capitalist is actually our second board index or second board on uh, that means names that don't qualify for the main board gets listed on the second board. A lot of these names are names that don't they're not profitable, names that are perhaps in the mining industry that tends to a very high risk after a couple of years of exploration, and they find nothing. So predominantly some of these names are there. So uh, like what I said, investors, please pay attention to small and micro caps, right? And of course, everyone new to a market, or in fact, even if you're not new to a market, we tend we tend to need to find ways to screen for ideas, right? For traders, you tend to find screen for ideas more frequently than investor. And of course, screening for ideas is part and parcel of what we do every day, um, especially in our line of work. Yeah. So one of the key things that you can start, or one of the key platform that you can start, would be the SJX Stock Screener. I've been tracking the screener for a while. It used to be very primitive, but it has improved with time. And this is a good place for you to start. You have quite a fair bit of options. Like for example, you can do your valuation screen. You can incorporate a bit of the momentum screen as well to make sure that you're not getting into some value trap. And of course, things like your profitability criteria are there as well. So please take advantage of it. This is free. And of course,
That's
our
available on, sorry, that's available on the sjx.com website, is it?
that's right. That's right.
Right. Okay.
I've actually put the source over there.
Yeah.
And of
Okay.
course, our own trading platform also has a stock screener, which we call the stock filter. Um, this is actually a third party platform that we host on our trading platform. And of course, what you see over here is some of the preset strategies that you have access to when you log in into this particular screener. Some of it, especially the more fundamental ones, like for example the emerging markets growth stocks over here that you see the top few, are actually curated by the vendor. Um, I actually created a couple of momentum screener somewhere in between these strategies over here. Like you can see the 6 month and the 12 month positive and negative momentum screener. This are actually meant and targeted at traders, not so much for investors. But I actually do conduct some webinars some time back to cater to two different markets because I'm very anal about differentiating whether you're trading or investing. So every time anyone would ask me any questions, I will typically get them to identify is it from an investment angle or trading angle, right? So this are two separate activities that we should be very clear what we're trying to achieve. Um, of course, I haven't got time to upload and change because, as you know, third-party vendors are not easy to make changes. Yeah, I
Mhm.
spent a few months trying to just make this available to our customers online. Yeah.
So
So
these some of these screeners on iTrade is basically proprietary to CGS-CIMB lah.
that's right. That's right. Yeah. Of course,
Okay.
I have a lot of models that I've got no time to, or yeah,
Yeah.
to upload and build it inside there. Yeah.
Sure.
Yeah. In fact, last time they only have 10. I requested for more.
So
Yeah.
now you have how many in there?
2, 4, 6, 8, 10. Well, we have 13 over here. Yeah.
13. Mm.
13 over here. Yeah. And of course, you can create your own strategies. Yeah, we have a function for you to create your own strategies. That means you go in, you tell the screener what you're looking for, and it will zoom down and yeah, give you a better picture of what you're actually looking for. Yeah.
Right.
The good
Okay.
thing about this screener is once you set the screener, you can actually run all the markets concurrently. Yeah.
Mm.
Instead of, let's say, some of the screeners you find online that is free, you can usually just run one market at a time. Yeah. So if, for example, let's just talk about the momentum strategy. If I were to click the momentum strategy, I would check all the round dots over here to say, okay, I want to screen for Singapore market, Thai market, Korea. It will run concurrently. Just that the results will come in and jumble up. It will come in all one big lump. It doesn't
Mm.
differentiate. Yeah. So to make things easier and simple for you, you screen for one market at a time. Yeah, so that you don't have all the markets all jumbled up. Yeah. And of course, you see high growth and consensus estimates, upgrade and downgrade. This boxes over here tells you whether how well these strategies are working, right?
So the platform that you have here on iTrade CIMB, the stock filter, is it available in the Malaysian platform as well, or is it different?
I just checked with my trading platform specialist. They say that it's available to the Malaysian markets as well. Yeah,
Okay.
correct. That means the Malaysian trading platform. But like what I said, sometimes the firm builds a lot of platform, a lot of tools for clients or for brokers to use. It tends to be neglected. You know what I mean?
Yeah.
Uh,
Mhm.
yeah, correct. Because we when we have easy access to something, we tend to
Mm.
just take things for granted, always seeking out for new stuff or new ideas. So
Right.
yeah, a lot of tools are actually just around us. We should make full use of it.
Yeah.
Yeah, correct. This is a very powerful tool if you ask me, because I've been using a lot of screeners since many years back. I've actually grown with all these screeners available in the markets, whether free or paid. Yeah, so this is one of the better ones. One of the better ones that are freely available to investors or traders out there. Yeah. Okay. So, and of course, my job as a strategist, not just in terms of doing technical analysis reports on a regular basis, but I also do a lot of quantitative modeling. In this case, for this event and to share with all the investors out there, all the like-minded people, that whether you are a pure deep value guy or whether you are, let's say, a quantum guy who are very open to using both both fundamental and technical inputs to create a strategy that you can rely on to use systematically over time, right? So that you are consistent, you achieve consistent results. And I yeah, especially created this model just for tonight, right? So I start off with Investable Universe. In this case, I tell my screener. I actually built this screener on Bloomberg. Um, I tell the Bloomberg says I'm starting with the Singapore Universe. Anything below the 50 percentile of the market cap, I'm not looking at it, right? So basically, I'm disregarding small and micro caps, right? 50 percentile is usually your mid and big caps. or with a bit of crossover into small cap as well, a little bit, right? Um, so in this case, I'm using a multi-factor model. I typically call it QVM, right? So it incorporates things like your valuation, your quality factor, and your momentum factor, right? To make this into a very simple, easy to implement strategy for everyone out there. Even though you don't have a Bloomberg, it's actually very easy to do so because actually a model, most of the efficient and effective model and robust models out there are actually very simple, right? But it's human like us, we tend to make things complicated. Actually, complicated models don't work that well. Yeah, trust me. Right, I do modeling, I back test, I've run, I think, definitely more than 10,000 back tests, right? Trying to create complicated models. But more often than not, I start off with a complicated idea. I tend to strip it apart, right? Because when I put them through the back test, I realize it doesn't work that well. I can't beat the market, right? I have high turnover, things like that. So complexity kills, right? Simple stuff works. It's a matter of being disciplined. So in this case, we're using a very simple valuation matrix like your P, right? So we screen out the lowest quintile, and for profitable for this quality factor, actually there's a high tilt towards profitability, not so much about balance sheet. So in this case, what we're trying to do is we're trying to avoid cheap stocks or relative cheap stocks that could potentially be lower quality or value traps. So in this case, I'm actually using ROE. Uh, this metric is very easy to use and it's very commonly available. That means most of the companies have an ROE number, right? So of course, some guys tend to be a bit more fanciful. You can use things like ROIC, ROC, but some companies actually don't have those numbers. Yeah.
Mm.
So, in fact, you won't be surprised that you have negative ROE. Yeah, right. So I'm using ROE. I'm using operating profit margin. Right. If anyone out there asks me why not use um, net profit margin, why not use gross margin? The key benefits of using operating margin is because I'm actually measuring the business, right? The operating margin profit, operating profit margin of the business, right? More often than not, accounting can actually cover up not operating stuff, right? So the key benefits of using that, in fact, I use it in most of my models. And of course, in this case, I used EPS growth over the last 1 to 5 years. Yeah. So I basically screen out the lowest quintile, which is the bottom 20 percentile. And of course, I also try to look for names that are moving positively up over the long term. That means 5, 3, and 1 year must at least not be the worst of the lot, right? So I just simply tell the screener I want anything above, anything in the range of 5 years total return to be at least positive. I don't want something that could be a potential value trap as well. Yeah. So in fact, some guys, without using quality factor, use value and momentum factor concurrently and can still create a very good model of it because these two are actually negative correlated. Yeah. So
Mm.
if let's say you find things that are too complicated, you want to leave out quality, yeah, why not? You can incorporate momentum to make sure that you are having a well diversified model. Yeah, these two models actually, um, how I should put it, they kind of offset each other. Yeah, to improve performance, actually most of the value guys are inherently riding on some momentum. Yeah. So for 3 years and 1 year price change, total returns rather, I also screen out the bottom quintile, and to make sure that it's investable, I also screen out anything that is not quite liquid. So anything above the quarter million ADV, for that matter, would actually more or less determine how much capacity you have in this model. So based on this, I can roughly say this model can run a $2.5 million investment portfolio, not a problem. You should have no liquidity issues or market impact. Yeah, anything more than that, we will have to tweak the parameters. Yeah, correct. So this actually can be done on your end. That means at the investor level, you have to ask yourself, what am I looking for? Cheap stocks that are not displaying negative momentum, right? Or names that potentially are very good in their profit margin. Yeah. So before you come to create this model, you need to ask yourself the questions: what am I actually trying to include in my investment portfolio, right? And of course, by incorporating things like uh, below that I'm showing you, you select the top 25 names with the highest indicative dividend yield. It's one of the post screening process. That means you are actually, this is what we call the portfolio construction process. Yeah. So it can even get more complicated um, for a portfolio with higher capacity or for more sophisticated investors, right? But nothing is set in stone, right? It's a very creative process because you will need to find something that suits you. I wouldn't I wouldn't advise everybody to use this model or to use this particular method because we will at some point, if too many people are investing in the same strategy, you would erode away the alpha, right? So, for example, you pick the top 25 names with the highest dividend yield, or you can actually pick the 25 names, sorry, the top 25 names with the highest ROE or with the highest operating profit margin, or you can actually pick the 25 cheapest names with after this model has screened out the resultant universe. Yeah, so it can be changed or customized. But of course, once you decided to do so, you also need to make sure that you back test it so that the strategy is robust enough for use or for deployment. Yeah. So the second part of the portfolio construction would be how do you decide to weight your portfolio or how do you want to allocate your money? Yeah, to make it sound simple, it's how you allocate money. You want to buy, let's say you want to have 10 names in your investment portfolio, you want to equal weight them, or you want to market cap weight, you want to risk weight, or you want to do factor weight, or anything, right? Every one of us should be different to express our investment strategy. So this part is very, very creative as well. So, of course, the second part of this would be how often do you want to rebalance your names, or in this case, in layman's term, how do you want to review? How frequent do you want to review your investment portfolio? Every 6 months, once every quarter? Yeah, it depends on how active you are or how inactive you are to review your investment, right? So of course, if you're running money, you decide when do you want to rebalance this. Too much is not good. So rather, too frequent is no good because you will have higher turnover, and that will inherently also burden you with transaction costs. But of course, too infrequent is not that good as well, especially when you try to beat the market, right? So once every 6 months is the sweet spot for most investors. If you try to if you're trying to be a very active investor, you're trying to beat the market on a regular basis, I would say once every quarter is the ideal number. Once a month, unless you are managing a trading portfolio, otherwise that's not recommended for an investment portfolio. Yeah, hope that I'm not too long-winded. Yeah, because I'm crazy when you talk to me about investments. I can't stop. Yeah,
It's a good thing. It's a good thing. I
I
think
can't
there'll be
stop.
questions coming in.
Yeah,
But
because yeah. Okay, so moving on, this is the resulting universe when we apply the screening model, and of course we have 25 names resulting from this model. You can actually constrain it to be 50 names, 100 names, or even 10 names if you want, right? So it's all up to you, right? We all have to decide what we are looking for. In this case, 25 names is actually a very nice statistical number to have a well diversified portfolio, right? If you're managing more money or a bigger investment portfolio, 50 names works as well. Anything above 100 names tends to be not that efficient. If you're very greedy, and actually there are some quant funds out there. In fact, some of those are funds that I really respect. These guys, they have in excess of like 400 names in their portfolio. Yeah, so yeah, that itself may not be a good idea. Yeah, but uh,
so this one is actually you specifically selected 25. When you do the screener, actually there are how many counters that met that screening process?
actually around 28 to 30 odd names, depending, because every time you run it, you have different numbers.
Right.
Yeah, correct.
So
But
normally
because,
it's around 30 counters like that. Lah.
yeah, correct. But if you don't change the criteria, the list of names are more or less there. It's very familiar names, right? Because you have predetermined what rules that you determine to look out for. Yeah,
Mm. Okay.
that's right. So, for example, you will find some names very familiar, like for example, Valuetronics. I'm not sure the boys in Malaysia are familiar with Valuetronics, but it's one of the not too bad names within the small cap space. You have DBS Group, you have your Yanlord, you have Capital Land, a well-known developer within the region, right? And of course, in this screener, we have two out of the three banks. Of course, I can't answer you why OCBC is being left out because maybe at some point, one of the criteria doesn't meet one of the criteria. Because oh yeah, I forgot to tell you that this screening model or this process is different from some of the process that people use. I'm using a simultaneous process. Some people call it the okay. It's all technical jargon, right? But effectively, it's different from sequential process or sequential screening. That means you take out the cheapest stock first, then the remaining universe, then you screen for, let's say, ROE or operating profit margin. So I don't do that. I screen for everything simultaneously so that yeah, it's more fair to, and if, in fact, it's been proven in a lot of research uh, journals as well. This method is a bit more efficient than the sequential method. Yeah, and I tend to like to use it more because it yields more results. Yeah,
Mm.
correct. So yeah, a lot of names like, for example, Venture Corp are household names in Singapore. Yeah. So, but of course, you do find that some household names are not appearing in this list. Yeah. So, of course, your next question would be, Jake, does this work? um, I would say if you selectively pick a couple of names off this list and you invest, I would say your results should still be fairly positive, but it lacks consistency in practice going forward. Yeah. So let's look at the back-tested results. So using this strategy, let's go back in time and say, okay, I were to use this strategy and be systematic about it. I'll buy 25 names, regardless whether the market goes up or down. So this is a long-only strategy, no long shot involved, right? Simple for most of the long-only guys to implement this idea. Uh, so you can see that it consistently outperformed the index ETF that I choose to use here, the STI ETF. So over a period of 10 years, you get about 31% total returns, cumulative total returns, right? So this is not annualized returns, right? So after a period of 10 years, you get total returns of 31%. If you are passive, sit there and do nothing, right? Just
Mm.
take the beta, the market returns over time. And of course, if you implement this strategy, you have to be actively managing your portfolio. And yeah, by being consistent and riding through riding through the up and down, yeah, market corrects, and you still have the balls and nerve to stick through the strategy, you will outperform the broader market. Uh, if let's say this strategy give you a total returns of 83%, you less all transaction costs, well, you can easily do 75% over time. Yeah, so
Mm.
you will outperform the broader market, but it takes time and energy and effort to do so. Uh, Outperformance don't happen by chance. So
Yeah.
yeah, correct. It takes hard
Re-
work.
yeah. Sorry. So the results that you show here is only on the buy side, right? So you don't have any sell here, right? It's just following over a 10-year period.
Oh no, actually yes, there is sell. That means
Oh,
whenever
there
you
is.
review your portfolio, you will
Mm.
look at a list of names whether it's it still remaining in that
Ah.
new portfolio. Actually, what rebalancing is basically you're reconstituting your portfolio on a regular basis. So if
So
let's say, yeah,
mm.
sorry.
Sorry. Go on.
So if, for example, if DBS is still part of my portfolio, my new portfolio, but this time around I may have to tweak with the weightage because, for example, if DBS goes up 10% or 50% when during the financial sector run 2 years back, right? Your weightage in your portfolio will go up. It
Right.
will naturally move up. So in order to bring it back to your original weightage, in this case is equal weight, right? The reason why we do equal weight in back testing is because you don't want any one of the names to dominate, and it will
Right.
give you a false sense of how this strategy works. How, yeah, basically the robustness of this strategy. You want to make sure that equal weight, you are giving them fair um, attention. Yeah. Correct. So by doing that, you are sorry, by doing the rebalancing, you're bringing the weightage back down to, say, for example, 5% or 4% in this case. Right? Bring the weightage down to 4%, then you, if the model doesn't say you have to eliminate the stock or DBS in this case, you keep holding to it. So essentially, you're holding on to your portfolio over time without trying to do second guess. That means, for example, Benny is telling me, oh, the market is going to crash tomorrow. Let's dump all the banks, right? So we are using a process to guide us, right? This process is what some guys fancifully call a model. Models is here to guide us so that we remain consistent in our process, in our discipline, to make sure that we don't deviate too much from our investment strategy. Yeah.
Mm. So the performance here that we see here is you're based on a 6 month rebalancing, is it? Every
That's
six
right.
months.
That's right.
Mm.
Equal weight 6 month rebalancing. What it doesn't tell you is the transaction cost.
Right.
Yeah, correct.
Okay.
And when you rebalance once every 6 months, the transaction cost not likely to be high.
Yep.
Yeah,
Okay.
correct.
Thanks.
No problem. Just to highlight some of the names, like for example, because just now that screen is a little bit small, so I just want to showcase. This is not to tell you to buy DBS now, but yeah, but DBS is one of the safest and region in the region, so it's quite an idiot-proof name if you ask me. Yeah.
Mm.
So whatever anyone says, analyst or me, I'm not an analyst, I'm a strategist. Yeah. So whoever comes in and tell you, yeah, don't buy the bank or what, you make your decision by looking at what you choose to do. For example, in this case, I choose to be looking at purely numbers, right? So um, if the bank right now is trading at 9.5, 9.6 times to earnings, less than 1 times to book, although okay, generally speaking, most of the banks, if they are a well solid bank, typically when they are trading close to 1 time to book, it's it's a buy typically, right? Um, but that's also provided it's a good quality bank, right? So in this case, just looking at the numbers, well, not too bad. We are at safe levels. We are not overpaying for the bank, and the ROE is pretty good. I'm looking at 5.4, 5.5% indicative dividend yield. Yeah. So as an investor, you ask yourself, even without using a model, right? You ask yourself, are these numbers good enough for me, right? Not to let subjective judgment to cloud your decision making process. So what actually I'm doing is to put all my requirement into a model and say, yeah, let's be fair towards all the names within the universe, or within the sector, or within the industry, to make a fair assessment which one is worth my attention, or which one is worth my investment capital, right? So yeah, just to showcase some of the names and some of the numbers that we are looking at. For example, in the industries sector, ST Technologies right now is trading 18.6 times to its earnings. Of course, for the deep value guys, this is not deep value, right? It's still relatively expensive, but you've got to look at it from a sector angle, right? In this particular sector, or in this subsector, because it is a defense contractor, right? It mostly does a lot of defense work, or it's in the basically it's a very unique positioning and a niche area, because it's, for example, in Singapore, it's a monopoly or a high barriers of entry. So very much like SJX is monopoly, it's not easy to enter that particular industry to compete with SJX, in this case, ST Engineering as well. So it has got certain advantages, or what some guys call moat, right? So if you do more in-depth analysis and deep dive into the valuation trend of ST Engineering, it never tends to get any cheaper than this, right? So it's yeah, we can deep dive into it, the valuation stuff, yeah, but it's typically not going to get 10 times to its earnings, right? Because there is a particular characteristics within the firm, within the industry. And if you look at the ROE, it's pretty attractive, 25%. I like it. In fact, disclaimer, I have it, right? I have it, right? It passes my investment criteria. I have it, disclaimer. Yeah. And it gives me a pretty decent dividend yield, 4.35%. And typically, when I enter the market is when it is being bitten down. I I typically act in contrarian with what traders are doing, right? But that doesn't mean I don't trade. I can trade, but I've decided I'm not trading this stock. I'm investing. I want it to be part of my investment portfolio. I buy when it's not fashionable, when the market is totally disregarding the fundamental strength of this stock. Yeah. So like recently, when the whole broad market is down, it got affected as well. The valuations are very attractive. I'm looking at it. Yeah.
Jake, there's a question earlier on the finance stock. Okay, there's a question here. Gonna bring out a question on the screen. He's from CH Ang. He says Singapore Central Bank has suspended dividend, or bank has reduced dividend in Singapore. Your number are historical dividend, is it?
That's right. No,
Mm.
sorry. The dividend is indicative. That means it's using a compounding. Sorry, it's using an annualized um, dividend paid out to
Right.
come. Yeah, so it's like an estimated dividend yield based on what was recently paid out.
I see.
Correct.
Okay.
Correct. And of course, you can use estimated dividend yield as well. Um, but that doesn't change the fact that yes, market environment or regulatory environment do change. Um, but then again, as an investor, you have to ask yourself, if I'm holding cash, will I even get 1% returns? Recently, I've been talking to a lot of friends, relative, clients as well, right? What in Singapore we hold our FD used to be about 1.8%,
Mm.
there about 12 months ago. Right now, it's less than 0.8%. Yeah. In fact, the interest rates environment, or rather the decline in the interest rates environment, is actually what we have already foreseen more than 12 months ago, because the Fed has been raising and they can't raise it anymore. Um, yeah, correct. They have to do something even before the COVID. And with the COVID, it only exacerbates the current situation. Yeah, so we have to ask ourselves, if I don't deploy my money into a relatively higher dividend paying stock, assuming price don't change, right? What do I do with it? Is there better opportunities out there, right? Not pertaining to DBS or to the banks, but as an investor, we always ask ourselves a question: what do I do with cash sitting there doing nothing, idle? Do I get 1% dividend, 1% from cash facilities, or your fixed deposit, or something similar in the money market? Yeah. So money needs to be working all the time. There's no point keeping idle cash. So I'm not saying you should buy DBS, but you should consider what you get compensated through dividend yields or through potential capital appreciation.
Mm.
Yep.
All right.
Uh,
Let's can go on now.
Thank you. Okay. Oops, sorry. Okay. So moving on to REITs. This AIMS APAC REIT is a logistic REIT, industrial logistic REIT. It's currently trading at 10 times PE, 0.88 times to book. Our REIT sector, or our REIT market currently, right now, it's on a tear, if you ask me, actually. If you just purely looking at valuations, most of it are trading close to 2 times to book. Most of them are above 1.5 times to book. So looking from a valuation perspective, not attractive, but of course, then again, um, you can still add those names to your watch list and wait for a pullback before entry, right? So nothing stopping you from buying higher or buying at the pullback, right? Anticipating that in the future you will, because long-term investing, you're likely to see, um, 3 to 5 years down the road, you are getting positive total returns, even by making a relatively high entry. Because don't forget, the dividend actually adds on to your total returns, right? So if let's say 3, 5 years down the road, your price changes 10% from your entry price, right? But every year you get 5% dividend yield, that adds on to be roughly 20, 25% of total returns. Yeah, correct. So investor need to think in terms of total returns, not just price change. Okay. So this is a relatively cheaper name within the universe that we screen out. Some of the names are in excess of 1.5 times the book, and PE is a bit higher. So just for your idea, and of course, Yanlot is a property developer that specializes or focus in China. Um, the tricky problem with this name is the valuations has always been cheap, right? It has a low PE for the longest time that I remember tracking it. I used to trade Yanlot a lot, if you ask me, because it's very tradable. If you look at it from a trend perspective, um, I can easily, because I'm a patient trend trader, right? That means my technical part, I trade a bit, and I also invest a bit. Um, I don't have this name in my investment portfolio right now, but from a technical viewpoint, because I find it very easy to read when it starts moving, and the volatility is not too high for me. And my usual 1 year return is about 15, 20%. Yeah, so I always incorporate that into my trading portfolio. That means I don't trade one stock, I also trade a portfolio. So when I do that, it actually lowers down the volatility for the overall portfolio. In fact, sometimes I trade long short. Yeah, you'll find that long short portfolio is very stable. Yeah, but of course, then again, what ideas to long, what ideas to short, we all need to do our own homework, right? So this name is quite cheap, right? Trading below half times to his book. And what is interesting is it's quite high in terms of its profitability. Right? I don't easily find property developers in the range of above 10% ROE. Right? But of course, you measure property developer using other metrics, but they tend to lag in terms of ROE. And of course, in terms of total returns, dividend yield is pretty attractive. Why not pay attention to some of these names, right? And of course, the short-term momentum, there is a bit of a positive momentum over the last 3 months. So maybe you can look at it and incorporate into your investment portfolio. Just some of these ideas that I'm throwing around to investors wondering what to invest, where to start their own research, right? And of course, um, approaching towards the last part of my presentation. Wow, gosh, I'm so long-winded. Okay, so sorry, I really try to pick up my pace. So the key takeaways for tonight is actually um, from an investment viewpoint, we should all retain a bit of flexibility. So this call and satellite model portfolio approach is actually quite commonly practiced in the advisory world or wealth management world, right? So actually what you do is you create a call balance portfolio. So nothing too sophisticated. Everyone knows 60/40, things like that. So um, just to give you an example, right? So, for example, anyone who haven't invested or who already has an investment portfolio, you ask yourself this: Do you have, sorry, do you have exposure to equities or and fixed income? In this case, bonds, right? Of course, the question is: Do you have global exposure? Global exposure actually gives you a more diversified stream of return because if, for example, Asia is not performing, US is performing, things like that, you don't want to time or rotate into markets because regional rotation happens over time as well. In some other talks, I've actually um, presented some of this evidence that rotation happens at the country or regional level. So if you don't want to time the market, you don't have professional management capabilities, right? So you may want to consider doing something like a static or a core portfolio, 60-40, right? But of course, in this case, 60, it's actually 30% to fixed income, 25% to stocks, and perhaps 5 to 10% of it in gold, right? That this portfolio is not meant for timing. It's just there to be an idiot-proof portfolio or allocation, right? Of course, if you have time, you have the energy, you have the hunger to learn more about investing and to be more tactical. You want to be actively managing your portfolio. You can try something like a satellite portfolio, right? You can achieve your exposure through, let's say, a REITs ETF or some thematic ETFs. For example, the global water ETF. I can't remember the code right now. Now, some of the ideas that you have in mind, you want to express them, you can do that through mutual funds, uh, ETFs. You can do that through single stock based on, let's say, if you're from the tech industry, some of the tech names are very good quality names, and you want to have exposure in it, doing your own homework, or maybe result from doing your modeling. You find that, hey, I want to invest in 5 names, so maybe you allocate a part of your portfolio to those names, so that your portfolio overall performance, your risk adjusted performance, will be different from what you envision to be compared to a static portfolio, right? So this is what I practice myself uh, for my investment portfolio. So I have a call, I have I have a static portfolio, right? I also have tactical portfolios. Those are the ideas that I get to shift, right? Those are not set in stone. When the market rotates into a different sector, I tend to rotate as well. Yeah, but that don't form the bulk of my investment portfolio. And of course, you can play with the weightage if this what you see over here don't fit in your context into your context. So um, with this, I would like to close my presentation and remind everyone, or remind all the audience and listeners out there, before you observe, oops, sorry, before you dabble into the market, or before you want to dive deeper into um, actively managing or become an active investor, please ask yourself a question again. Are you more suitable to be an investor or trader? I've actually known some guys who wants to be an investor, but they don't have the right mindset to be an investor. They're very kanchong spider. Yeah,
Mm.
so correct. So the psychological makeup don't allow them to practice long-term investment. So identify your own psychological profile. Are you a trader or investor? Right. And of course, understand your risk appetite is very important, right? How much risk you can tolerate. You can find that out through putting on a couple of trades, and you observe yourself for the next, say, for example, 3 to 4 weeks, and you see how your mind reacts to the price fluctuations up and down, right? Does it affect you badly? If that's the case, I think it's more like you should consider yourself a low risk investor, and yeah, and you should stay away from trading, right? The next thing would definitely be deciding on the strategy. You want to be a pure fundamental guy. You want to be a fundamental guy. That means taking some technical inputs into your fundamental strategy. Why not? Right? Let's not be too close-minded about it, because as long as it works, right? It works for you. That's the best thing it can ever happen. No point following a strategy blindly, right? And of course, the last point would be construct and hold a diversified portfolio, so that um, your returns are a little bit more stable. And of course, if you're able to identify low correlation among your assets that you're holding, or stocks that you're holding, that's even more ideal. Yeah, because stocks, or generally asset classes, have high correlation, right? And you can diversify that through holding fixed income, or through holding gold, for that matter. If you're more savvy, we can talk more. Feel free to drop me a line or drop me an email anytime. And Of course, last but not least, investors should be patient, right? If you're the patient type, you are very likely having a head start to being an investor, right? Investors should be those type who wait for the queue, right? You can stay out for the market and wait for the market to correct over 12 months or over 2 years. Wait for it to come to your level. When the market don't love it, you go for it, right? Traders should really chase a short-term trend and do sector rotation and see what's hot in the market. Because if you have the flexibility, your psychological profile fits into a trader mindset, please do it, right? Don't force yourself to be an investor. Don't make yourself who you are not, right? And of course, if you're keen to explore investing in the Singapore market and you like to open an account, and today you're in luck because I've actually worked out with our management. If you're not a client yet, you can sign up with us uh, and be the first 5 clients to complete the first 10 trades within 3 months to get to redeem a free AirPod. And of course, you must remember, please use the referral code SGTUE. And for any inquiries about the trading platform or account opening, please contact Colin, our colleague in retail management. Yeah, you can drop her a line. Sorry, you can drop my email. You can call her. And of course, last but not least, um, I want to remind everyone that due to geographical constraint, we can only accept account opening in Singapore. That means an account at the Singapore site. Hopefully, we can extend in the future. We can extend this promotion to the region, but we have a lot of things to sort out before we do that. And thanks for your time. I would like to close this presentation and wish everyone the best of health in this period. I'm ready for questions or further questions. Benny?
All right.
Yeah,
Sure.
thank
Thanks, Jake, for this comprehensive presentation.
you.
So you're mentioning that the account opening, I mean, if I'm a Malaysian and I want to open an account, I have to be in Singapore to open the account, right?
Uh, Good question. Uh,
Which
because
is right now quite impossible because of the restriction in movements, right?
that's right. That's right. That the COVID actually causes quite a fair bit of problem for us right now. Um, Online account opening, I don't think we are ready yet. I'll need
Mm.
to check my colleague, but we used to have a lot of Malaysians residing in Singapore who just opened a Singapore account with us. Yeah.
Right,
So
right,
yeah. So,
right.
but don't worry, we're trying to figure out something down the road. Yeah.
Mm. Yeah, and of course, if you really want to trade Singapore shares as well, even you can open an account in Malaysia itself. You can actually trade Singapore markets if you really want to do it as soon as possible, right?
That's
Um,
right. That's right. Of course, don't trade for the sake of trading. You need to know uh, you have a valid reason to have Singapore stocks into your portfolio for diversification purpose or for some other reasons, like for example, protection in terms of currency. Currency
mm.
exposure, it's also what a lot of investors in Malaysia are concerned about. Yeah,
Okay.
yeah.
Yeah, so guys, you just contact Colleen if you're really interested in the Singapore market, and if let's say you can't open an account in Singapore, I think Colleen will be able to assist you on how you can open an account in Malaysia itself, right? So just contact her. If you're really interested in the Singapore market, and if you would like to reach Jake, how can they reach you, Jake?
Yeah, you can always drop me an email. My email is Jake. Okay, I'm sorry. Let me move back. Jake.chow at CGS-CIMB. Can I share screen?
Yeah. Anyways,
Oh,
guys, you can download the slides in a short while. So I will, Jake's contact will be there. Colleen's contact will be there.
correct.
Just in a short while before we end, I will share with you how you can download today's slides. Yeah.
Yeah.
Okay. Maybe Jake, there are a few questions that come in, so maybe we want to look at those questions. Um,
Okay.
okay. So if let's say I'm a investor who have invested in Malaysia before, but do not
Mhm.
know about the Singapore market. So how can I start as a new investor in Singapore? Or what should I
I
be
would,
looking at?
I would suggest an index ETF like the STI ETF. We actually have two ETF that are tracking the STI ETF. Sorry. One is the Spider STI ETF. The stock code is ES3.
Hmm.
Let me just call up my Bloomberg. ES3. Oops, STI. The exchange code is ES3 on the Singapore side, but the Bloomberg code is oh, sorry. Okay, sorry, just give me a minute. Let me pull
Hmm.
up.
Okay, guys, for those who are asking about brokerage fees and so on and so forth, please do contact Colleen, right, to get an idea what kind of brokerage the CGS-CIMB is charging. You know, of course, with different levels of capital that you trade, we have different prices. So please do contact Colleen, yeah. Okay, I'm just trying to look at the other questions. And another question about, you know, I think for Anthony asking, how do you get information or a free stock app that provides stock fundamental details, chart announcement, and so on and so forth? You know what? You can download the SJX app. Okay, I think we have already put in the comment section down there. It's available for everyone, and it's also provide real-time prices, data, and also news. Okay, so it's free. You can download in the App Store. All right. So just look for SGX app.
That's right. That's
Okay.
right. Yeah. Benny, I've just shared the
Re-
screen with you. So
Hmm.
there are currently two ETF tracking this SCI index. One is by Nicole AM. Nicole Asset Management used to be TBS uh, Asset Management. So these two ETF tracks the STI index, and they are charging the same expense ratio, 0.3%.
Hmm.
Yep. So these are the actively traded index ETF we have in the Singapore market. So as a start, if let's say you don't want to do stock picking, you want to have market exposure, you can consider this ETF.
Hmm.
Yep.
Right.
Right.
Okay.
Same,
Sure.
yeah. Same thing. You can always invest in Malaysia for in Malaysia ETF as well. Uh,
Hmm.
yeah. Correct. If you don't want to do stock picking, you want to get market exposure, or you want to
This,
deploy excess cash or idle cash. Yeah, that's one thing to do.
so you reckon ETF is a best place to start if you want to really get engaged in the market itself, like
That's
Singapore.
right. That's right.
Yeah.
In fact, I create my own Singapore, as in my Singapore exposure using the STI ETF, and I
Hmm.
overlay with different stocks that I want to. For example, I overlay with. I shouldn't be saying this, but I hold SGX as well.
Hmm.
Yeah, right. I hold SGX, so I hold ST Engineering. I hold. You'd be surprised. I hold StarHub, the telco,
Right.
because yeah, I use StarHub, and I was actually I started out my career in StarHub. Yeah, but
Hmm.
uh, not to yeah, it's not an investment idea, but I have exposure to StarHub because I want to get paid dividend for my my telephone bills. Yeah, so
Hmm.
actually by holding shares and getting dividend paid, yeah, you can offset your dividend your phone bills. That's one
Right.
another way of looking at it. It's not a brilliant investment idea, but yeah, just to offset some of the expenses. Yeah, for example, if you're a frequent traveler, yeah, maybe you should own SIA. Oh shit, I shouldn't be saying that. But yeah, uh,
Yeah.
yeah, correct. These are some strategies actually people use anyway. Yeah,
Hmm. Okay.
yeah,
Great. Same thing about we also say here in Malaysia, right? So if you have like you continue to buy Milo and you continue to buy those milk and so on
correct. Why
Mami,
not?
just get Nestle, right?
Correct.
That's
Yeah,
something.
yeah. It can be your strategy as well. If you're
Yeah.
consuming this, why not invest in it? Be a shareholder. If you treat stocks like a business, I think you should be quite sensible and logical when you are able to see whether the business is performing or not.
Yeah, and generally, like right in Malaysia itself, consumer companies or consumer stocks are defensive in nature. Is that the same
Yeah.
thing in Singapore? No.
Generally, yes. Consumer staples, whether in Singapore or all parts of the world, is typically considered a defensive thing.
Yeah.
Yeah, they tend to have higher dividend payout, but one of the drawback is consumer typically has got a higher leverage.
Yeah. What
broadly.
about REITs, Jake?
Yeah.
Should I also look at REITs in Singapore because it's one of hot REITs in Singapore as well, right?
Yes, you should. I believe everyone should have some exposure in REITs. But if even if you don't have the STI index already has got some exposure in REITs. Yeah, just a bit, correct. But if you
Right.
want, yeah, if you want, what you can do is actually you buy the STI ETF and you buy a REIT ETF. Yeah, so using two trades, you gain exposure to the index, STI index, and to the REITs universe as well.
So, in your opinion, Jake, when would be the right time to get into, let's say, REITs or even ETFs?
Um, okay, this is a $1 million question. Everybody asks that. When is the best
I
time?
mean, right?
Sad, but I would say we miss a very good entry point, especially for REITs. A good entry point would be during the COVID,
Hmm,
correct? But most of the REITs have climbed back from the bottom, and it's one of the better performing sectors and asset class in Singapore. Yeah, for example, the banks have been down year to date, or even in fact over the last 12 months. But some of the REITs have recovered a lot of their losses.
hmm.
Partially because of the fact that the investors, global investors, are chasing dividend yield. Okay, I wouldn't say global. Most of the investors in Singapore are chasing dividend yield. Yeah,
Right,
and
right.
yeah, dividend yield is a very prominent feature or a risk factor in Asia. It doesn't work very well in US though.
Hmm.
Yeah,
Okay, I still have a few more questions, but any questions that are related to individual stocks, we will not bring it up here today. What you can do is you can personally email Jake an email on his presentation slides later, right, to get in touch with him. So
yeah.
at least then he can answer you because we don't want to show this, analyze it in public, lah, right? So get in touch with Jake.
Thank you
The
very
email
much.
is in the presentation slides, so I'll share with you later how you can get the presentation slides, right? Okay.
Yeah.
Now there's a question on from CH Ang is asking, Singapore is being very dependent on tourism. Will retail REITs recover back to post-COVID in view of second or third wave? I guess is the infection.
Again, this is something that is very hard for us to predict. Yeah, as of now, our second and third wave infection in Singapore is not that bad because we choose to close down. We went through the suffering first, and right now the rest of the world, um, for example, um, where else? Hong Kong are suffering from second and third wave.
Yeah.
Um, I would say it's a chain reaction, right? Uh, Even if we are open up, we don't have the second and third wave. The incoming tourists from Hong Kong, from I would say most part of the world, will not be coming in. So the impact is naturally there. But of course, some of it has been absorbed into the price over the last 12 months, or actually over the last 6 months. Um, the big impact or the big drop comes in March. So right now in August, yeah, around Feb, March, we start to feel the impact. But the market is always trying to price in the negative stuff. But sad to say, even with the drop, the valuations are not that attractive. Yeah, if we go back in time and we look at um, the valuations at that point in time, it still wasn't very attractive then. But it's the next of the best or best of the worst as of now because as I mentioned in our Singapore market structure, the main driver of returns is coming from REITs, coming from the property sector. So when people are making those decisions, they tend to look for the best of the worst. So if you want to deploy money, the safest route would still be putting some money into REITs. So
Mm.
yeah, that's the key driver because it promises revenue stream. So that's why when the sharp drop came, the investors are also quite quick to realize that, hey, if I were to deploy money, this is the next best thing right now.
All right. Okay, guys, I know there's still questions coming in, but we are running out of time. I know if you have any other questions, please do get in touch with Jake. The email and all that is in the presentation slide. So to download today's presentation slide, you can see the rolling screen or rolling text down there. Just WhatsApp us at 8408-2070. All right, so it's a WhatsAppable number, 603-8408-2070. Just say hi in the WhatsApp, and then you should be able to see some replies. So select number 3, which is Copy Time Freebies Singapore. All right, and then you should be able to see the slide there. You select, and then you should be able to download the slides. So Jake's contact number is over there. Anything that's got to do with accounts, please do contact Colleen. The email is also in the slides, and it's also in the comments section. All right. So we have to end here today. Jake, thank you so much for your presentation.
Thank you, Benny. And
yep,
thank you everyone for tuning in.
Yeah, thanks everyone for tuning in tonight. Like I said, this is the first series of the SJX Tuesday that we're going to keep on conducting for at least another 15 more sessions. So that's where we're going to focus on sectors and industries. And we're going to even bring some CEOs of the public listed companies in Singapore to share with us the industry itself. Right. So please do join us next week as well, the same time on Tuesday at 8 p.m. Until then, please do contact Jake. Please do download the slides to get his number. All right. So anything you want to basically share with the Malaysian audience before we end, Jake?
I wish everyone find your investment objective, and good luck to finding yourself. Good luck in finding yourself a strategy that you can stick with, and good luck in your investment success. And of course, money is not everything. The key thing is still to stay safe. Even if your portfolio performs very well, not having the best of health is not going to work. Yeah.
Right.
So stay safe, stay healthy, stay happy. That's
all right.
the key. Thank you very much.
Awesome.
Yeah.
Yeah. Health have to come first, or not well, right?
Yeah, correct. You can't enjoy the wealth without your health.
Right. Yeah. Okay, so yeah, guys, thank you so much for joining us, and we'll see you again next Tuesday, Singapore Tuesday, same time at 8 p.m. So have a good night, and we'll see you again tomorrow. We have another session which for our members, so please do get in touch with us to attend that particular session exclusive for our members. So till then, we'll see you again Singapore Tuesday next week at 8 p.m. Good night.
Thank you, everyone. Good night. Thank you.